if you don't look at climate, you're basically making an implicit assumption that things will stay the same forever in the future and that you're not going to change growing conditions or water conditions on that land over time. And we think those are challengeable assumptions.
Welcome to Sustainability Leaders. I'm Michael Torrance, Chief Sustainability Officer at BMO. On this show, we will talk with leading sustainability practitioners from the corporate, investor, academic, and NGO communities to explore how this rapidly evolving field of sustainability is impacting global investment, business practices, and our world.
The views expressed here are those of the participants and not those of Bank of Montreal, its affiliates, or subsidiaries.
Welcome back to another episode of Sustainability Leaders. I'm Angela Adduci with the BMO Climate Institute. Today's guests are deeply immersed in the world of regenerative and sustainable agriculture and bring unique firsthand experience delivering financial returns from regenerative or sustainable approaches. Our first guest, Alyssa Go, is Head of Impact at RRG Capital Management. RRG is a sustainable real assets management firm with $3 billion in assets under management, over 20 years of experience, and projects across the U.S. West, Latin America, and Australia. RRG focuses on land, water, agriculture, biodiversity, and energy investments in premier agri-food regions where climatic or market stressors present new opportunities. Our second guest, Craig Wichner, is founder and managing partner at Farmland LP. Farmland is an investment fund that acquires conventional farms and converts them into organic and regenerative farmland, thereby increasing land value and gross margin per acre. Farmland has over $350 million in assets under management and manages over 19,000 acres across Northern California, Oregon, and Washington. In this episode, we'll unpack the work that these two firms are doing to achieve both financial and impact returns from sustainability-aligned agricultural practices. Alyssa and Craig, thank you so much for being here today.
Great to be here.
Thanks for having us.
So both of your funds focus on the idea of sustainable practices, things like regenerative agriculture, responsible water management, land reuse, as financially accretive when implemented appropriately and smartly. So could you give us an overview, each of you, of your organization, your approach, and maybe how it came to be? And let's start with Craig and then move to Alyssa.
Great. Thanks so much for having us here. So Farmland LP was founded 16 years ago in 2009 with a straightforward thesis to acquire conventional farmland and convert it to organic and regenerative farmland management, and thereby adding value to those farmlands. So we do buy conventional farmland, convert it to certified organic and regenerative operations, and then both manage them directly as well as tenant out some of the land under our management practices. And overall, the whole system is designed to add value by converting it to healthier soil, diverse high-value crops, and gain organic price premiums as well, which drives both income and land appreciation as well. And as you said, we manage $350 million worth of farmland across about 20,000 acres in the western United States. We grow over 40 different crops on our land. That's very diversified from a cropping operation, from a tenant operation standpoint, as well as climatological differences across Northern California, Oregon, and Washington as well. And fundamentally, we are value-add farmland managers on this, allowing investors to gain access to farmland as an asset class, which is a very stable, non-correlated asset class, and get the benefits of both asset appreciation and cash flow from these assets. For the investor audience, farmland is a wonderful addition to a portfolio. It is a non-correlated, durable asset that generates appreciation and cash flow. Fits somewhere between a bond and commercial real estate with the stability and great returns. Farmland in the U.S., for example, over the past 85 years has generated returns of around 11% per year, unlevered, half from cash flow, half from appreciation. And Farmland LP has a boring name because we want to provide investors with access and ownership to that asset and adding value in ways just by doing simple, non-controversial things like focusing on healthy soil biology at scale and leaning away from the chemical dependent commodity agriculture system.
RRG has been working in this space for more than 20 years, and sustainability has always been core to our work. As you mentioned, we're an investment firm and asset manager with $3 billion in assets under management and investments across the Western US, down through Mexico, Latin America, and Australia. And we focus on these arid permanent crop regions that supply the fruits and nuts that everybody loves. We invest primarily in real assets with market rate returns. So we'll often buy large agricultural properties and then redevelop them into a mix of uses, like a smaller footprint of permanent crop agriculture, water infrastructure, things like groundwater banks, solar, and a native habitat. And we also do redevelopment of underperforming permanent crops, expansion of permanent crops with more resilient water supplies, and make investments in vertically integrated produce companies. So we have our largest fund is a $1 billion fund called the Sustainable Water Impact Fund, or SWIF, which we launched in 2019 in collaboration with the Nature Conservancy. And we think that fund really highlights the type of impact that we're able to get with our investment strategies. And I'm looking forward to talking more about that.
Alyssa, you mentioned the climate opportunity. And I think when we talk about, right, the intersection of climate change and agriculture, I think a lot of the focus, rightly so, ends up being on the risks that changing climate poses to agriculture, not just in the US, but, around the world. And what I find interesting is your funds move beyond this understanding of the risk itself into a proactive strategy, this value add strategy, value creation that seeks returns based on an understanding of these risks, but also a response or a mitigation. So could you both speak to these opportunities, maybe both from a financial returns perspective, but also from an impact perspective that you've captured from moving beyond this pure risk perspective to an opportunity standpoint?
Yeah, I mean, of course, there's this strong relationship between ag investing and climate change. Climate change has huge impacts on agricultural operations. It's no wonder that everybody focuses on the risk side, because across the spectrum, you have chronic, acute, transition risks, all immensely affecting ag investments. But like you said, on the opportunity side, climate change is quickly shifting how land and water are managed around the world. It's reshaping water availability, land productivity, conservation priorities, and therein lies the opportunity that RRG sees. We believe that real asset investors, especially those in ag, are very uniquely positioned to support this sort of global sustainable land and water use transition, a lot like the energy transition that always gets talked about, by investing in these adaptation strategies. So what we do in practice is we use climate sustainability screenings to guide how we initially think of portfolio development, and then how we're making siting decisions and individual project plans, and then how we get impact out of this work. One example of this is an early investment we have in our Sustainable Water Impact Fund called Caponera Creek. Originally, it was 7,000 acres in California's Central Valley, just a little bit north of Bakersfield. And it had 2 massive dairies on it, plus land growing feed crops. And as many people know, the Central Valley is an incredibly tough situation for water shortages, groundwater overdraft, and among other things, the Sustainable Groundwater Management Act came into effect in 2014, which triggered more regulatory restrictions. All of this is contributing to dairies, among other things, going out of business. So we bought this land knowing a few things. One, that prior land use was no longer sustainable. 2, it was in a good location to do groundwater banking and recharge. 3, some of the land could still remain in agriculture with shored up water supplies. 4, that various parcels were fence lined to the Pixley National Wildlife Refuge. So there was the possibility of having conservation related exits. And then 5, potentially some of the land could also be of interest to solar developers. So we took control of this property. We decommissioned the dairies. We sold a portion of the land very quickly to a permanent crop developer who planned to keep some of that land in production. We used some of it to develop groundwater recharge banks, and then we acquired add-on properties to build out that water business plan. And then we sold some land next to the wildlife refuge to the district, who was able to transition it to a land trust. And that land right now is currently being restored by the Nature Conservancy and the Thule Land Conservation Trust.
Alyssa, it's great to be on this call with you. You have such a great perspective on a broader global perspective of the challenges and opportunities that are happening in the world. Angela, you asked about risk and the opportunity set there. There's a simpler layer underneath that, which is basically your view on change and really the landscape associated with this. If you look at, for example, a flat map of Europe. So I play Risk with my friends sometimes, and it's a nice flat map of the world in Europe, and you can just move things around, and there's a certain understanding that you get. But if you look at a three-dimensional map of Europe, you see the Carpathian Mountains, and that dramatically affects the political and military situation that's happening right now in Russia and Ukraine and Poland and the other areas that you wouldn't see if you just looked at this flat two-dimensional map. Climate is that third dimension for agriculture. If you don't look at climate, you're basically making an implicit assumption that things will stay the same forever in the future. And that you're not going to change growing conditions or water conditions on that land over time. And we think those are challengeable assumptions on there, that there have been changes in the past. We think that there are modelable scenarios of changes happening in the future. And when you incorporate that three-dimensional landscape view, some very clear risks and opportunities come out of that. And really from the start of Farmland LP, we baked in those change scenarios. We only buy farmland in areas that we think will do as well or better in the face of these scenarios in the future, and avoid the areas that we think are going to do worse. For example, certain parts of the US and the world are going to get hotter and drier. Some areas are going to get wet and have more humidity. That could be a good thing. It could also be a bad thing as well, depending, like late season moisture when you're growing corn, when you're trying to dry it down, causes tremendous fungus problems as well. So you need to really understand what the agricultural impacts of potential climate change are. It's actually benefited Canada quite a bit. If you look at the growth of corn production in the Canadian center, it's increased significantly, partially from genetics, partially from climate as well. So when we look at these scenarios, we really identify that water becomes a critical factor in this, that some areas, that agricultural production globally is actually going to decline a bit, and it's going to rely much more on certain areas as well. And we talk about sunshine, dirt, and water. Sunshine is great growing climates. Dirt is high quality soils. And water is both the physical access to water as well as the legal ownership of that water as well. And so we bake these things in, and that's how we really assess where we're going to be buying farmland. And then we look for farmland that's growing low value crops today. Commodity crops, for example, but the soil and the climate has the capability of growing higher value crops. And it's based on a fundamental understanding that the value of farmland is based on the value of the crops that you grow on that land. So by increasing that cash flow, you're increasing the value as well on that, and then leveraging economies of scale. So we're really leaning into $50 to $100 million worth of farmland in one tight geographic region so that we can really benefit from those economies of scale. And this combination, results, we have a 4,000 acre farm in California where we have converted that from really conventional commodity agriculture to organic, regeneratively managed farmland, increased the value of that farmland from $30 million to $90 million. We've taken it from 2 farmers to 7 farmers, from 3 crops to 12 crops grown on that land, and increased our gross profit on that from $300 an acre to over $800 an acre today, and increasing, with some of the oldest water rights and most secure water rights in California. And so when you layer in climate change just as part of the landscape, a lot of opportunities pop up. It affects your strategy, like focusing on high quality farmland with great water rights, as well as avoiding whole geographies. And it actually creates a more compelling growth opportunity strategy for us as we look out into the future.
This is fantastic. I find it really interesting to hear not just the impact that you both talk about here, but the different ways that you're achieving returns in the broad sector of agriculture, but things like conservation, water rights, yield, things like that. I think it's very fascinating to hear all the different ways that you're approaching this. One thing that I did want to double click on is, you both, I know RRG has more of an international scope. Craig, you mentioned you have a very tight geographic focus in the American West, but you both operate in the American West. I think this is really interesting because you mentioned the Central Valley water issues, challenges there. We hear a lot about just general agricultural challenges in that region. So it's very complex. And then there's a regulatory dimension as well. And there's just a lot of shifting factors. And I was hoping you could both reflect a little bit on the decision to enter that market to focus on the American West.
All right. Well, hopefully we can spend some time on water rights. It's a fun and rich and complex topic. And there's, again, a lot of opportunities there. And I think it's probably one of the most misunderstood asset classes and has the most economic upside on it as well. It's just really essential to understand water at a deeper level. So the U.S. is a tremendous agricultural powerhouse. 53% of U.S. farmland produces two commodity crops, corn and soy. Most of that grows in the Midwest. Along the West Coast, you have over 300 different crops that are grown, and really a tremendous amount of the high value permanent crops, for example, are grown on the West Coast, leafy greens, etc. Why is that such a great productive region? In part, it's the soils, the water, but in part it's due to the cold current that goes down the West Coast of the United States. So the water circulates the way that it circulates on the East Coast of the US. You actually have a hot current that goes along the East Coast, and you have a cold current that comes down from the Arctic down into Mexico that actually acts as a natural air conditioning system for the West Coast of the United States. And that in particular creates nice cool evenings and moderates the higher temperatures. And that is really a wonderful growing environment for fruits, nuts, vegetables, etc. So this is a long-term durable thing that benefits both agriculture as well as in the face of climate change. And what we find is that's a big reason why we started along the West Coast. The United States also has wonderful economies of scale and great growers. It's also a great market for high value crops. So we specialize in organic production. That's about 6% of the US food budget is spent on organic food. Almost all of that is grown in the US and consumed in the US. So about 1% of US organic production is exported, and about 7% of organic consumption is imported. So for example, the trade issues that we just had, very little effect, in fact, a slightly positive effect on the organic markets.
And for RRG, the decision to enter the market in California, well, first I'll say our founders were based in LA in the early 2000s and had a background in water, expertise in water. California produces roughly a quarter of America's food, 90% of our fruits and nuts, and 70% of the vegetables. And I think even back in the early 2000s, it was clear that there were significant water issues. Groundwater overdraft was occurring, subsidence where, pumping was happening to degrees where land had been sinking up to 40 feet in certain places. California has this incredibly complicated, fragmented water system with, taking all of the snowpack and the rivers coming off of the Sierras, damming them up, building large canals to take water to the south, take water from the north, all over the place, through the Delta, distribute it to farms in the Central Valley, and then bring it down even to cities in Southern California. And before the Sustainable Groundwater Management Act, groundwater hadn't been regulated. We entered knowing a couple things, that there was one of the early investment strategies that we had was groundwater banking. It's a strategy that I think is kind of universally seen as beneficial to farmers, water supplies, and very supported by NGOs and public interest groups. You're essentially just taking water that's running off in a wet season that isn't needed for agricultural supplies, is beyond what might be needed for environmental purposes. And instead of having that water run out to the ocean, capturing it in holding ponds, they look like big rice paddies. They're low impact infrastructure you can build on ag lands to let that water percolate back into the groundwater system. So one of our early assets that we built is we call Homer. It's a network of water banking facilities in different areas of the Central Valley, connecting to different infrastructure, allowing us to capture that wet winter water when it's not needed. It's also a diversity of water supplies from different parts of the system and an ability to trade and move water to get it to places of need. And it's a network of public-private partnerships that we have with irrigation districts. So how we got into California was, building those type of water investments early on. SGMA came into effect and required that irrigation districts start to self-organize, come up with plans to use groundwater more sustainably, get those plans approved by the state, and then implement them over the course of decades. Those calculations are showing that water use needs to drastically change. Some estimates are, on an extreme side, expecting that up to 500,000 acres of land could come out of production. So all of these characteristics and our knowledge of water really opened up this opportunity, we think, for the Sustainable Water Impact Fund, which is helping invest in these changes and transitions and bring that water knowledge to the Central Valley.
Yeah, thanks to you both for touching on water. It's such a critical part of the conversation, especially in the American West. Both RRG and Farmland have such a clearly strong foundation of both investment expertise and then scientific or technical backgrounds that are sort of married together. So, Alyssa, you talked about your partnership with the Nature Conservancy, as well as your founder's background in California with the scientific ag background. And then Craig, you mentioned your background in biochemistry and microbiology, and you also have internal farming experts that work at Farmland. I'm curious to hear from both of you. Do you see this sort of combination of investment expertise and scientific knowledge, or really deep technical knowledge, as critical to the returns and the success that you've had over the years? And, if you could dive in a little bit on where you've seen really great breakthroughs and combining those backgrounds, as well as, where there may have been challenges in bringing that together, I think that would be a really interesting story to hear.
Yeah, it's a really good question. Of course, our internal expertise on water, agronomy, solar development, the real estate transactions, it's all critical to the work. The person component is very important. Having a team of people with many years of experience that have gone through the ups and downs, gone through all of the tough learnings, and can work together on a single project. We end up having our lead for renewable energy constantly talking and collaborating with our head of farm operations, being brought in on projects in Chile, Australia, same thing with our head of water going down to Peru to help with projects. So that collaboration's definitely critical. But I would love to talk a bit about the partnership with the Nature Conservancy, because it's been so formative for me and for my team in the firm. And it's a unique approach that we've been really proud of. And I would really also encourage other firms to pursue partnerships like this. We started with TNC about 10 years ago, right, as they were launching NatureVest, their impact investing arm. And structurally, the collaboration is innovative in the finance space. We know that adds real value to the fund. They sit on our technical advisory committee, and that committee reviews all of the potential investments and has minimum standards in doing its review. And NatureVest's managing director also has a vote, a really important voice on our investment committee for SWIFT. A portion of our economics as the GP is also contingent upon the fund achieving these real and specific conservation objectives. I actually had helped manage the SWIFT One fundraise, and I went on the road with our firm's founder and TNC for many fundraising meetings. And I know the partnership had been really meaningful to a lot of our LPs interested in impact work to validate our credibility in the space. And then in terms of actual process, we've incorporated TNC into our deal reviews. This work brings financial value. I mean, one obvious way is through the conservation exits and prepping investments that can have those exits. And then other values are through detailed screenings of things like surface water, groundwater, deforestation reviews. I think one of the big learnings coming out of SWIFT One for us, for me, heading our impact program, was how much of the sustainability and impact work happens during our investment strategy development and our pipeline development and diligencing the pipeline. That's this work that we do around this sort of master planning exercise. So not only to tee up these conservation and protection wins, those can bring in financial value, but they're also helping us have exits for portions of the property early on in our holding period. They're allowing us to have exits that are uncorrelated to a degree with ag markets. So there's a variety of benefits that we're seeing with that work.
Farmland LP is one of the 14 largest farmland managers in the US, but we're the largest focused on organic and regenerative agriculture. And we started out 16 years ago with the mission to demonstrate that organic regenerative agriculture was more profitable than chemical dependent commodity agriculture. So from day one, the investment analysis, the investment returns were just as important as managing the farmland with healthy soil biology and regenerative agriculture in the process. These are not separate things to us. These are not, the organic and regenerative is not a bolt-on to us. It is really the key way that we actually view farmland as a biological system rather than a chemical factory production system for the industrial inputs of industrial corn, to an ethanol facility, for example. That the focusing on the asset itself, how do you manage farmland in a way that actually is integrated with nature and that works with farmland in the diversification that it wants as part of the ecosystem without the toxic chemicals that used to create that kind of sterile factory environment that conventional agriculture has? How do you work with the ecosystem? And our whole model is really built around that diversification. And that means that the people who are here understand that and actually see the world from that lens. So my degree is in biochemistry and molecular biology, and I grew up managing investment real estate, apartment buildings, and have built technology companies, et cetera. So the whole model really is built around this, what now is called kind of impact-oriented, non-concessionary return financial management of the farmland. We work with our farmers, get their information, but we're the ones who are doing the organic certifications at scale. And we can do that very efficiently and effectively. And the farmers get to focus on creating the value out of that land and growing those crops. It would be very operationally complex for us to grow 40 different crops on our land and work with all the ecological benefits by working really, you say sustainable agriculture is a team sport. So by working with multiple players here, it really works well. And there's a lot of value that comes out of it. We do extensive tracking of the ecosystem service value that is produced farmland, like clean water, clean air, soil carbon sequestration. We are just about to release, well, we've already filed with the certifier, the first regenerative agriculture carbon credits in the US. So those are at Vera now. We're expecting those carbon credits to be certified and then expect those to be sold very quickly, really representing the first monetization for large-scale regenerative agriculture carbon credits in the United States. Microsoft invested with us in our third fund in part to help us really advance regenerative agriculture carbon credits on this. So part of the reason why we've invested in this, we've been working on carbon credits for 16 years, really since we started. It's never shown up on our financial statement because it's really quite challenging to do. The regulatory markets are really soft, the commercial markets are strange. But really starting 2 years ago, we were able to work with another group, put a great program together, and we expect really in the next quarter or so to have approved certified carbon credits for sale that will really, in essence, change some of the economics of buying farmland and generating carbon credits, especially through cover cropping on farmland. And we hope that has a very large scale impact. Farmland has the opportunity to be the largest carbon sink in the world after the oceans, if it's managed well. And so one of the things we're doing is try to help push that future forward.
Not surprised to hear Microsoft's name come up around carbon credits. Very interesting. Thanks to you both for taking us through the value proposition there. I think you said, Craig, you said the magic words. You said non-concessionary returns. That's awesome. Really quick, could you each take us through what are you focused on in the next year or so?
Farmland LP, we're just closing our third fund. We've already bought a lot of assets in Fund 3, apples, cherries, almonds, organic vegetable ground, a number of permanent crops across all 3 geographies that we're in today. So we'll close that fund and buy additional assets, and then we'll launch another fund later this year. That's one main component. Secondly, we do expect the carbon credit issuance from Verra, which would allow us to actually deliver cash flow on our farmland, as well as add that carbon credit as a recurring revenue stream in our financial models going forward. We have not been able to do that in 16 years.
And for us, my team's focus has been really, or is for the coming year, on figuring out better climate modeling and tools. I love hearing about Craig's process. I want to hear more about other people's processes, finding just the best tools, data out there, how to gather and analyze it for both chronic and acute risk mitigation. I think everyone in ag investing is figuring out how you deal with these 100-year events that are coming over and over. And I know that we have room for improvement. The investment world has room for improvement. Like, we need to get the reductions in the use of agrochemicals and progress on organics and regenerative practices. And for us, doing non-concessionary work in the high-value permanent crop sector, we're taking learnings from row crops and figuring out how to do it more wildlife friendly, trying to do reservoirs that help wildlife corridors, testing cover crops, bringing some of those learnings over. So I think, climate modeling, bringing these wildlife friendly practices into conventional farming, and then always as an investment firm, we're focused on exits, lots of exits, working to get money back to our LPs.
Thank you both for joining us. This has been fantastic.
Thank you so much. We're so appreciative of you for hosting us and getting to learn from others today.
Wonderful speaking with you today. Thank you so much.
Thanks for listening to Sustainability Leaders. This podcast is presented by BMO. You can find our show on Apple Podcasts, Spotify, or your favorite podcast player. Press the follow button if you want to get notified when new episodes are published. We value your input, so please leave a rating, review, and any feedback that you might have, or visit us at bmo.com/sustainability leaders. Our show and resources are produced with support from BMO's marketing team and Puddle Creative. Until next time, thanks for listening, and have a great week.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.